Okay, so the YouTube algorithm served me up this video from Dave Ramsey on why you should focus on paying down the mortgage over investing. And I'm like, I gotta hear this because this is one area, despite I love so much of what Dave does, and he's a great guy. I've met him in person. I've made a cameo on the Dave Ramsey show. But this is one area where I would say I disagree, and not only disagree, but strongly disagree. So let's check this video out, see what he says, and see if he can change my mind.
John's with us in Chicago. Hey, John, welcome to the Dave Ramsey Show.
Hey, thanks for taking my call.
Sure. What's up?
Got a question. I have been able to save up quite a bit, a decent stash of savings, and the only debt I have is a mortgage. Mm-hmm. I've always been an avid investor, and I was lucky enough to get locked in at a low rate, about 3.25%. Mm-hmm. So just curious your thoughts, having a difficult time convincing myself to pay off my mortgage with such.
I would too. 3.25% is a great rate. And you also get the deduction on mortgage interest, potentially, depending on your tax situation. So the effective rate is even less. And when you look at where inflation is, like last I checked, it was at 3.1. So if your mortgage is what did he say, 3.25%, and inflation is 3.1, it's almost like free money, because the longer you take to pay it off, the more you're using the future dollars, right? So I would be struggling with this as well.
A low rate.
How much do you owe on your mortgage?
About $180.
Okay. And how much is the non-retirement nest egg?
About $90.
Okay, I like that he's asking these questions. So he's not just giving some blanket answer oh, just pay off your mortgage, or oh, you should invest. He's let me get the full picture, which I think is so important, because so often I see, personal finance people just being do this. And it's this blanket advice that they give to everybody. And I'm always well, it depends on the situation, because everybody's situation is different, right? And so there are probably some cases where I would be oh yeah, just pay it off. I don't know if this is one of them, but I like that he's digging a little deeper and not just giving some stock answer.
Okay. And so you don't have enough to pay it off?
Correct. So I've been trying to decide, does it make sense to just throw that chunk at that?
Okay, I got you. Okay, even though it doesn't pay it off. Okay, and what's the home worth?
About $520.
Good. Okay, and how much do you have in retirement?
401k of about $150. Mm-hmm. IRA and Roth of about $100.
Okay, how old are you?
35.
Okay, good. You got a great start. What do you make a year? Household income?
Household income is $140.
I'm glad he asked how old he was, because that was one of my questions too. I was okay, we really need to know how old he is, because based on what he has in the retirement accounts, it's not like he's got enough to be able to retire on that right away. But if he's 35, then he has some more runway. He has some time to let that money grow and compound for him.
Oh, great. Yeah, you're in great shape. You're doing great, man. Okay. Well, here's what we teach, and then more importantly, why we teach it. Okay. What we teach is a thing called the baby steps, where you're debt-free, everything but the house, and have an emergency fund. That's 1, 2, and 3. You've done that. Then we suggest at baby step 4 that you start investing in retirement, 15% of your household income. Are you doing that?
I'm on board with this so far. I do like that Dave recommends that you start investing for retirement before you work on paying the mortgage off, because in general, in the baby steps, right? Because at the end of the day, you can't eat equity, so if you end up with a paid for house, but you're living on cat food, that is not great, right? So we do want to make sure that something's going there.
Yeah.
So you got $25,000 going into retirement accounts a year, $2,000 a month.
Yeah, but 10% in my 401k, and then about another 10% just goes into savings.
Okay, but it's not going.
I see Dave. He's okay, 20%, 10% into savings. So I think that we'll see what Dave says, but I do think that you want to look at what is enough savings. So Dave would recommend having a 3 to 6 month of living expenses reserve fund, and then beyond that probably be paying off the mortgage or investing or a combination. And I think this is one of the things that trips people up, when they don't know their numbers and they don't know how much they need to have in reserves. Then it's just like, well, I should just accumulate and accumulate and accumulate, and when do I invest? And it creates a lot of angst and uncertainty and even money leaks, because they're not optimizing how they could be deploying their money and getting their money working for them, while hedging against risks. It's not like they're like, rolling the dice. They're, intelligently investing and building. But I think that that's a powerful thing to understand, is like, how much is enough in savings? And when you have enough in savings, then unless you're saving for a specific thing, like saving up for a car or a down payment on a house or a specific vacation or something like that, then should probably be putting more into investing.
Into retirement.
Well, yeah, 10% going into the 401k.
Okay.
That's retired.
So we suggest, I'm just trying to clarify where you were on what we teach, and then I'll go back to why.
Sure.
Okay. So 15% of your income going into retirement is what we would recommend. And so that would mean you would put 10% in your 401k and 5% more into Roth IRAs in good mutual funds. And in your 401k, you'd be in good mutual funds. That's baby step 4. 5 is kids' college. Do you have kids?
I do.
And you need to say.
So I want to just pause there. So the reason that he's suggesting a Roth IRA, first of all, because this is a person in the United States. So if you're in Canada, the nearest equivalent will be a TFSA, which is even like kind of better than an IRA, or an ISA that invests in stocks and shares if you're in the UK. But what's so great about those tax sheltered retirement accounts is that they allow you to grow your money tax-free. Oh yeah. And then with the Roth and the TFSA, with like those specific ones, it allows you to take money out tax-free. So it is like the easiest, most accessible, most passive way to become a tax-free millionaire. So I would agree with Dave, like 100% Roth IRA is like, that's definitely high up in Penelope's hierarchy of investment accounts.
For their college, right?
Right.
Is there something independent of what we've talked about that's covering that I don't know about?
They do have 529 plans.
How much is in those?
About 75 between the two of them.
And they're how old are kids?
5 and 8.
Okay, so you got a really good start there. Good. So we can kind of check that box, and you just keep adding. You've been adding systematically to that, it sounds like, and you'd keep doing that. 6 is pay off the house early. So above 15% going into retirement and above kids' college check, we would say throw everything at the house, which is the $90,000 that's in discussion here, unless you don't have an emergency fund. If you don't, we'd use some of the $90,000 for that and throw the rest at the mortgage. Why would I do that? Okay, and the reason is very simple. As we've studied millionaires over the last 25 years, and we just completed the largest study of millionaires ever done, over 10,000 of them, we find, to start with, that somewhere in the neighborhood, 79% inherited nothing, and somewhere in the neighborhood of 90% inherited not enough to make them millionaires. So 90% of millionaires, in other words, are not millionaires because of inherited money, but because of their habits and what they do with their money. And the two...
Okay, I just want to pause here and say that I love that he did this survey, and I love that he's basing this on real data versus just some theory or idea. But it's like, this is what we've seen. This is the data that I am referencing to make the recommendations that I'm making. I do have respect for that. And so I would agree with him on that. If he's got the $90,000 sitting there, that part of that would be the reserve fund to make sure that you're covered there. The 15%, I'd be curious to see why he says 15%. I've heard some people say 10%. I've heard some people say 15. I've heard some people say 20. And then you get to the FIRE movement where people are like putting like 50, 60, 70% of their income into retirement. And I don't necessarily recommend a set percent because, again, it depends on your situation. So I think that the real thing to look at isn't some percentage of your income. It's what would it cost to actually support your lifestyle to be financially free? So what is your financial freedom vision? What's the life you want to lead if you didn't have to work for money, right? And then put numbers to that. Like, how much does that actually cost? And then based on that, you look at like, okay, this is how much money I need. This is how many years until I want to be there. So let's say you want to retire in 10 years, 20 years, 5 years, whatever it is. So you're like, here's where I want to be. Here's the length of time to get there. And then what kind of return on investment do you feel like you can make on your money? And what do you think inflation is going to be? So you can play with a compound interest calculator and look at those scenarios and see like, how much would I have to invest each month to hit my goal? And to me, that's like way more meaningful than some percent. Like, oh, just 10%, 15%, 20%. And I get that people like to have a guideline. So if you want to start putting some percent away, like, great. But I think like looking at your real numbers, that's reality. That's real. That's like creating your own personal economy of abundance. And I think that is really the way to go versus some percentage, like I mentioned.
And the two primary things we see that those habits that cause them to be successful, meaning hitting $1 million net worth and above, is the primary initial levels of wealth. The first million or 2 million is 401k and a paid-for house. Now, the paid-for house not only is going up in value and stabilizes, but we do not find them saying, I'm going to borrow as much 3.5% money as I can borrow because I can invest it and make a better rate of return. We do not find them doing that. We find them getting the house paid off and using the increased cash flow of not having a house payment to then go bananas on their investing, and their 401ks and non-401k investing starts to go through the roof. But if we fast forward your situation like 5 to 7 years.
So I can see what he's saying, and I see where he's coming from. So I don't think it's necessarily a bad thing, because once you do pay off the mortgage, you have more cash flow, right? But again, I think it depends on your situation. Like, his mortgage isn't super big. I think he said it was like $180,000. So let's say you're kind of like getting close to the end of like being able to pay off the mortgage. If you can knock that puppy out and it frees up a ton of cash flow to invest, that might be the way to go. So in that case, you're not just looking at the interest rate, you're looking at the cash flow, right? Which is one of the things you can look at in the pay off debt versus invest equation, right? Like, what's the interest rate, the ROI, how does it impact you emotionally, and like, how does it impact your cash flow? And that's important. So like, for example, on our place in Silicon Valley, my husband had bought that, 25 years ago. And when we got married, the mortgage was only like 15 grand at that point. And it made sense to just, knock that out and get rid of that payment. And if you look at the payment as like a percentage, like as if that was the ROI, the payment times 12 divided by the principal, it freed up so much cash flow that it would be better to do that and invest. However, on another property, where we owe, almost $1 million, it's going to take a long time to pay that off and get that boost in cash flow. So I think at that point, it's better to invest until maybe we get to the point where we're like further along in the amortization schedule where we could like knock it out and it would be a meaningful percentage of the cash flow. So again, I think it kind of depends on your situation and how much cash flow you can free up by paying it off.
And you're sitting in this house, by then it's worth 700, and by then you'd have 500 in your 401ks, probably 700 in your 401ks. You'd have about $1.5 million net worth, $1.7 million net worth, of which 700,000 is your house. You would be typical in the case study that we've done. You'd be a typical case study of the representative statistically of the typical millionaire. If, however, you didn't pay off the house, you might still reach millionaire status, but you would be very unusual among that group. So the data points tell us that the millionaires are paying off their house. Now, why would they do that? Because of risk. Because 100% of the foreclosures occur on a house with a mortgage. And when you have zero mortgage and you walk in the backyard and the grass feels different under your feet, it's mine, by God, kind of thing. it changes the way you operate the rest of your money because you're standing on such a more solid foundation to live your life.
So I agree with that. You know, there is a lot of just like security and stability and peace in having a paid for house, right? He's talking about risk, okay? So when you borrow money, there's some risk in that, okay? However, there is also a risk in not investing. And I would say that is a very real and very huge risk. Because again, you're not going to be able to eat that equity, right? And you can't really it'd be very hard. So be very difficult to save your way to financial freedom because even just inflation is constantly eating away at the value of your money, right? So at some point you have to invest. You have to invest. It's the only way to do it. You have to invest. And by the way, you're already investing. But you can't not invest. There's only 5 main assets that you can be in, right? There's stocks, real estate, bonds, commodities, currency. And so if all your money is in cash, then you are 100% invested in currency. And the value of that currency, even though you might have had $1,000 yesterday and you have that same $1,000 today, the value of it, the purchasing power is bouncing around and changing all the time, just like a stock chart. So it's the same thing. It's just we don't viscerally feel it. So I agree with this emotional and behavioral side that Dave is talking about. I think that makes a lot of sense. But in this case, if he doesn't have enough money to pay off the mortgage, right? He's got $90,000. Let's say some of that is going to go into a reserve fund, and the rest isn't enough to pay off the mortgage. It's not enough to get that cash flow boost, at least not yet. I would be more inclined to invest it in the interim, and then once he gets to the point where he could pay it off, then look at how that impacts the cash flow and see if it makes sense to do it at that point. But let's see where Dave goes with it.
You don't, a lot of people change jobs because they're no longer worried about losing something. They were in a job they hated just to pay bills. They change careers. They take a little bit of more calculated risk or something, and we see their incomes go up overall. And so it's more than just a...
So he's saying you're taking on less risk here so you can take on more risk over here. Oh, okay. I see it. But again, I think that there's risk on all sides, right? And no matter what, there's always socioeconomic factors that are just outside of your control. And so you got to look at taking a calculated risk, and having a mortgage is a calculated risk. But then again, so is not investing or investing in one thing versus another, right? So I think that you need to take all of that into consideration.
0.5% mortgage versus mutual funds return. There's risk in there, there's life in there, there's stability in there, and that's why we're seeing these millionaires do that. So all of that to say, I would pull enough out of your $90,000 if you don't have a separate emergency fund to fund an emergency fund of 3 to 6 months of expenses. I'd throw the rest of it at that. I would adjust your saving by up 5% into, so you got a total of 15 going into retirement, 5% more going into Roth IRAs and good mutual funds. I think your kid's college is on track. I keep doing that. Throw the rest of it at the mortgage, and then anything else you find in your budget that you were saving above that 15%, I'd throw it at that mortgage till that mortgage is gone. I think your mortgage will be gone in about 3 years, and you would never borrow on a paid-for home to invest, and so you wouldn't keep a mortgage. Hey, good question. Thanks for letting me walk through it with you.
I think it's interesting that he made that assumption that you would never borrow on a paid-for home to invest. I totally would. I totally would. Now, it would have to be, again, a very educated, well-calculated risk, right? I wouldn't go into that lightly. But let's say I found a really awesome investment property and I was able to get it under market value and the cash flow was amazing. And let's say that, I could get an investment property loan at 7%, but if I borrowed it against my own house, I could get it at, 4%. Well, I might do that, or I might even take some money out of my house to put towards the down payment on that. I might do that if it made sense. Again, it's depends on the situation, right? But yeah, I would totally consider it, especially as you get older, you know, like if you're in your 50s, 60s, 70s and up, this whole like paying off the mortgage and saving and all of that is great. But sometimes just mathematically, it's not enough to get you where you need to go in your biological lifetime. So sometimes I do think you have to take a little bit more of a calculated risk to be able to retire, to be able to, you know, be financially free, to be able to have some more, you know, financial spaciousness. So here's what if I were on the Dave Ramsey show, or no, not if I was doing the Penelope Jane Smith show, and somebody called me with this question, I would say I'd be the same as Dave in terms of like, take that first chunk to fund your reserve fund. And then what I would do is, yes, increase the savings rate into investments, but I would do it based on their financial goals, not just an arbitrary percentage. Like, you want to be here by this time, this is how much you need to invest. And that might be 17%. I don't know, like, let's base it on their actual situation. And then the extra money, I would invest that at least until you have enough money that you could pay the whole thing off. Because like, even if you just put it into a high yield savings account or a money market account, right? Like, as I'm recording this video, that's giving you like more than 4% in interest. So even that is giving you more than what you're paying on the mortgage with no volatility, FDIC insured, you know, all the good things. So that seems unbelievably low risk. And then that little extra bit of interest helps build that up to where you could then knock the mortgage out even faster if you wanted to. So that would be my approach. Let me know if you agree, disagree. Let me know in the comments. If you found this helpful and interesting, tap the like button for the YouTube algorithm. And if there's any other videos you want me to react to, please let me know. Thanks so much for watching, and happy investing.